Pure Financial Advisors, a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full informed investment decision. This is Your Money, Your Wealth on Talk Radio 760 KFMB. Now, here's Joe Anderson and Big Al Clopine.
Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson, Big Al hanging out. Hour 2 coming at you. Appreciate you hanging on. If you have questions for us, you can always email us directly or go to our website at purefinancial.com. It says Ask an Advisor. Alan and I usually get those. We get a lot of your emails each week. I have a few more that we'll read off a little bit later. But I know Alan went through the 6 key ways to do it, and we've only gotten through 2, and so we want to make sure we get the other 4.
You notice I'm fidgeting.
Yes.
6 reasons to do Roth IRA conversion in your 50s and 60s, and we went through want to leave a legacy for your kids, grandkids. Agreed with that. You'll face higher required minimum distributions in retirement. How about this? Maybe kind of less well known, but you plan to move when you retire. Maybe you're living in a low-cost tax state and you're going to move to a higher-cost tax state. That can be. And if you're listening to our show on a podcast, and let's say you're in Florida and you want to move to California, guess what? Your tax rate's going up substantially when you get here. So a better time to convert will be when you're in a lower tax state.
So how about this, Al? Let's say I live in California. I'm going to move to Florida for a year. I do a Roth conversion. And then I moved back to California.
That works just fine. You really have to do it, though. You can't fake it. I mean, I can't tell you how many times people have come to me and say, I want to be a Nevada resident for tax purposes. And they kind of give me a little smile. And I say, well, how do you do that? They say, well, I got on the website and I saw this little place that they'll set me up with a P.O. box and it looks like I really lived there. And I would say that doesn't even come close to working. The Franchise Tax Board is too good at catching these scams. But if you really do move to Florida for a year or 2, do your Roth conversions and move back, that's fine. You didn't have to pay state tax on that Roth IRA conversion.
So what, 12 months?
Yeah, I would say 12 months. I mean, more importantly, there needs to be a conscious effort to actually move. In other words, you move up, you move your stuff, you move yourself, you start living there, you buy groceries there, you have
sell
utilities.
Your home here?
That's better, but not all people want to do that. So that's not necessarily a requirement. That does increase your case. But you want to change your driver's license, your registration on your car, your registrar of voters, on and on and on. It's a big hassle. So if you're just doing this for a year to do a giant Roth conversion, it might not be worth it for you. But if you really do plan to move for a while, and maybe you're like this. Maybe it's like, all right, I'm going to retire, move to Florida, and you move there. You do all these Roth conversions, and you go, you know what? I don't really like the humidity and the bugs, right? Now you know about Florida, Joe.
I do.
So you might come back, right? So that can be a good strategy. Here's another one, Joe, which is you fear the wealthy will lose Social Security. That's an interesting one, right? Because there is talk about how to fix Social Security. I personally think what they'll do is they'll raise the retirement age. They may raise the rates. They may raise the amount that we put into Social Security, raise the salary limits. But some people think they're going to go into a little bit more means testing. And if you're concerned about that, when you get your money into a Roth IRA today, you pay the tax today, but not in the future. So as far as a required minimum distribution at 70.5, there is none for a Roth IRA. And in fact, you can pull those dollars out anytime you want, and it's not really going to affect your income at all. So yeah, that could be a good one. How about this? Your taxable income will be low this year relative to other years. This is one of the biggest ones, I would say, and people miss this all the time.
Right.
I mean, how many times, Joe, have we had a person come into our office?
Negative income.
They have a business, they lost money, they had taxable income of negative $100,000. They weren't too excited about the year as far as finances, but at least they didn't have to pay any taxes. And they could have done a $100,000 Roth conversion and pay zero tax. And in fact, if they're married, they could have done a $175,000 Roth conversion and only pay up to 15% tax on $75,000. The other $100,000 would have been tax-free. It's a gigantic strategy. And something else, Joe, is when you're a business owner or real estate owner, there are opportunities to create deductions. Sometimes, like if you're a business owner, you can buy extra equipment, or you can sort of manipulate when you receive your income or when you pay your deductions. Or if you're a real estate owner, there's something called a cost segregation study that you can actually do that allows you to take a lot more depreciation on your property. When you do these kinds of things and create some big deductions, why not take advantage of those deductions by doing Roth conversions? We actually had a case a few years ago where there was a cost segregation study on a large property where the taxpayer got a deduction that they wouldn't have otherwise received of about $500,000. They did a $500,000 Roth conversion and paid zero tax on that conversion.
Right. It's just looking at setting yourself up to say, all right, well, if I'm looking to try to get money into a Roth, what's my tax bracket today? And is there different things, different strategies that I can use to lower my tax bracket today to get even more money into a Roth IRA? So you don't want to do this in a bubble, in a sense. You want to look at several different areas here. And I think that's where, when people write these articles, it's, all right, well, here's 5 great reasons or 6 great... And then people read it, well, it doesn't make sense for me because I don't fall in here. No, I think it makes sense for most.
Right.
You have to look at so many different factors when it comes to this type of planning. It's a little bit more sophisticated.
Yeah,
right?
And a lot of times, Joe, it's you don't have to have real estate, investment real estate. You don't have to have a business. You might be an employee. Let's say you and your spouse make $200,000 and you're thinking, gosh, I would like to do a Roth contribution, but I'm over 194,000, so I'm not allowed to. Well, are you maxing out your 401k? No. Well, why don't we max out your 401k? If you're over 50, that's $24,000. So let's just, simple example, you're not doing a 401k, so you max it out. Now your income is about 176,000. You're below the income limitations. You can do a Roth contribution. And by the way, now you've saved taxes because you were in a higher bracket by putting money into a 401k. And in some cases, with this strategy, you get yourself into a low enough tax bracket, you can actually turn right around and do some Roth conversions.
Right.
Because you're in a low enough bracket.
Right.
It's putting these things together to figure out what's going to be the best thing for you.
It's looking at your tax bracket. It's looking at how much money that you have in retirement accounts, how much money you're going to have in fixed income, such as pension, Social Security. Are you going to work part-time? You got to put all this stuff together to figure out what is the appropriate strategy. But each of you have a strategy. You just got to figure out what strategy is appropriate for you. You can't, listen to one snippet on the radio or read one thing in the paper and say, no, it works for me, or yes, it works for me, because you could miss a huge opportunity, or you might be doing a strategy that probably doesn't make any sense.
Yeah, case in point, Joe, a few years ago, we had a guy listen to our radio show that converted his entire IRA. He retired. He converted his entire IRA, let's call it $300,000, to pay off his mortgage of $300,000. Right? And so think about this. He retired, and he retired towards the end of the year. So he had basically a full year salary plus extra because he had accrued vacation that was all paid off. Now he's got a $300,000 income from taking money out of an IRA, right? Paid off his mortgage, and he's got no money to pay the tax whatsoever.
Well, yeah, he's got a lot more money in the retirement account,
right,
to pay the tax, but he doesn't have anything outside of the retirement account.
Yeah, exactly. So at any rate, you gotta look at all components together, because if you don't, you can make some big mistakes, and we see it over and over again.
Maybe you've diligently saved and invest for retirement, and if so, that's great. But the truth is, that's probably half the battle here. It's what you do with that money that really matters. How will you put your money to work for you while reducing your risk? How will you avoid the retirement tax trap that we've been talking about that could cost you thousands of needless taxes, penalties, and fees? And, how could you prevent a sudden illness from turning into a financial catastrophe? Got to take a break. Show's called Your Money or Wealth.
Now back to Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the show. Show's called Your Money or Wealth. Joe Anderson, Big Al. Thanks for tuning in today. Check us out online at purefinancial.com. Go to our website there, Pure Financial. It's open 24/7.
Yeah, the website.
Yes,
it's
it is.
A new improvement, huh? Used to shut her down at, 5?
Yeah, we used to 9 to 5.
Yeah, it's a new world out there.
All right. You got something else, or do you want to go to the email bag? What do you want to do?
Yeah, no, I want to do this. This is a new retirement survey that just came out, 17th Annual Transamerica Retirement Survey.
Okay.
And the article is written by Steve Vernon, right? We know him.
Steve Vernon, sure.
Yeah, Money Watch. He calls it Boomer Retirement Plans, the good, the bad, and the ugly. Remember that movie?
Yep.
Clint Eastwood. Yeah. Anyway, so there's...
Did you see the Magnificent Seven?
No.
You know, it's coming out again.
Is it?
Denzel Washington's in it.
Oh, I did know that. Yeah.
I think I'm going to have to check that out.
Yeah. Let's see. So here's what I want to say, Joe. So this is 4,161 survey members, full-time or part-time employees who worked for for-profit companies with at least 10 employees. And so first of all, let's do some good news. Everyone's always saying bad news. Here's a little bit of good news about our boomers. Right? And so boomers have heard and accepted the message that they'll need to work in their retirement years. Well, that's good. Only about 1 in 4, 26%, plan to immediately stop working when they reach a certain age. 2/3 plan or are already working beyond age 65 or don't plan to retire at all.
Yeah, but half of people are forced into early retirement.
That's right. And
because of health issues, because of layoffs, because of numerous reasons.
That's exactly right, and that's in the bad.
Oh, sorry.
But you're right. You're right, and so that's good. I mean, we want to be working longer, and that allows us to save more.
Yeah, the Employee Benefit Research Institute does that every year, too. They take a look at what age do you want to retire and what age do you actually retire.
Right.
And more people are saying, hey, I want to retire a lot longer. I mean, I'm going to work a lot longer.
Right.
But in actuality, more people are still retiring at 60, 62.
I know. It's crazy. It's still that average age. And here's another good thing, which is the vast majority, 83% of working boomers are saving in a retirement plan.
Okay, how much?
Well, that's $1.
Right.
$1 a year. Well, it's according to this. Now, this sort of contradicts other surveys that we've seen, but it says they're saving at high rates. The median contribution is 10% of their salary. Almost 2/3, 61%, report that they're also saving for retirement outside of work.
Of what? This is a survey?
Yeah.
Of how many people?
4,161.
And then are they all professors at Harvard, right? What's the pool?
Well, I don't know. It doesn't say. It just what it says is they work for profit companies. They either work full-time or part-time, and their companies have at least 10 workers.
All right.
Okay. Anyway, so let's start with the bad. And here's what you said, right? They may not be able to continue working. About 46% of current retirees report that they retired earlier than they had planned, often due to hardships such as health problems, disability, getting laid off, having to care for a spouse or parent.
All right, so that's the bad news there, right? Is that, and unfortunately, we don't really see a lot of those individuals at our firm, right?
Sure.
Because, they might not have any assets in a sense, right? Because a lot of people don't. What's the 40-some-odd%? I think it's 45%, give or take, don't pay any taxes.
Right. That's right. It's almost half.
Because they don't have enough income to hit the threshold.
Right.
Right.
Which is amazing.
And so half of our population doesn't pay tax. And then you look at 60% of the population doesn't have anything saved for retirement. Right, and then you have some people that have saved, and then the most that they've saved is $10,000.
Right.
So a lot of those individuals, right, we can't necessarily help because it's like, okay, well, you should have saved more here. You can invest in this, index fund, and
all we can say is start now, right?
Right, exactly. Start now, and
here's a program to do that, and of course you can, even if you got nothing, you can improve your situation by starting now, and that's one thing you can do. But let's say you're a year from retirement and you haven't saved anything, right? It's like, well, I guess you're going to have to work longer, or you're going to have to be okay with living on your Social Security, which is probably maybe 1/3 or maybe 25% of your income, something like that.
But then here's where I see, and you and I see, Al, a lot more. And it's getting more and more common. And I don't know, I would say it's just the past month, probably, 20 of this type of scenario where someone retires that can afford to retire, has the assets to retire, but shouldn't have retired.
Right.
You know what I mean? It's like, now what?
Yeah.
Because they were diligently saving. They were hard workers. They worked their way up the chain and said, you know what? Hey, I'm 65. I'm 63. I'm 60 years old, whatever. I have enough assets. I don't spend a ton. I'm going to retire. 6 months later, they're killing themselves. Because, right? It's like, now what the heck do I do?
They got nothing to do.
They got nothing to do.
Their whole purpose went away. And the other thing related to that, Joe, is those that have diligently saved and been frugal, they can't all of a sudden spend in retirement.
They're awful spenders.
It's like they got $4 million and they spend $30,000 a year. And,
if that.
And Social Security's $35,000.
Exactly.
It's like, well, Joe, Al, I can't. What else would I do?
No, I would break out in hives. You can spend about $150,000 a year. Are you kidding me? Oh, shut up! Don't tell my spouse that, right?
We get kicked under the table.
Like either or. I'm not saying the male's the spender, the female's the spender, whatever.
Sure.
If you're a saver, it's very difficult for you to spend, and that's another problem. I mean, it's just another problem. I mean, it's a good problem to have, but it doesn't necessarily matter. If I got $25,000 and I'm happy in retirement, I'd much rather be happy in retirement with $25,000 than have the $4 million and being miserable. Right? What's the money for then?
Yeah, exactly. And Joe, along this line of thinking, so the baby boomers understand they're going to have to work longer, but about 50% will be forced into retirement for one reason or another. And then you look at this. And this is, again, part of this survey where there's ways to increase your probability that you can continue working, right? One is staying healthy. One is performing well at your current job, keeping skills up to date, networking, meeting new people, going back to school, learning new skills. It's like only a half of people have taken 2 of these steps, right? And 1/3 have taken 3 of the steps. It's like you should be doing all of this at all times. If you want to be relevant into your 60s and even 70s, you got to stay current. And if you're not staying current, guess what? Your employer's going to find someone that is, which is probably younger, and probably they can pay for a lot less salary.
Yeah, most definitely. I mean, that's just another thing of, finding that purpose or staying active in your brain. Because it's like, we don't know anything from, birth until like 25. Then you know a bunch of stuff from 25 to 55, and then from 55, then you start losing your stuff again.
You forget it. I just read an article in
right, you're stupid, then you're smart, then you're stupid again.
Just read an article on AARP. So if you keep exercising and eating well, getting plenty of sleep, you actually can continue high-level brain function into later life.
Okay.
Yeah, so that's what I'm going on.
Like, you're only 59.
Yeah, well, I'm still, and I just had my physical yesterday.
Top shape.
Good shape. Yep, ready to go. Good for another year, pending the labs. We'll see what the labs say. But Joe, a lot of boomers have understood that they need to save more for retirement, and I think many are getting more serious, which is great. But a lot of them are not really thinking about taxes, and they're not planning for taxes, and because. Here's the thing, taxes don't stop when your paycheck does. When you start tapping your retirement nest egg, there's all kinds of new rules. The required minimum distribution rules, penalties, what accounts to take from, how to create the most tax-efficient distribution strategy from what you have. How do you do that? As you near retirement, tax planning becomes more important than ever, but you must use a forward-thinking tax strategy because truly you got more control over paying taxes in retirement, more than you think, more so than any other time in your life.
All right, we got to take another break. Show's called Your Money, Your Wealth.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson here, certified financial planner with Alan Clopine, of course. He's a CPA. Thanks for tuning in. Go to our podcast at iTunes. iTunes. Your Money, Your Wealth.
Yeah, we even have a TV show called Your Money, Your Wealth TV. You can find that on our website as well as YouTube.
Yeah, have a nice little email.
I saw that.
Yes.
One of our listeners, watchers.
North Carolina.
Yeah, right?
He's like, hey, all my friends, they watch America's Got Talent. They're going to be broke.
I watch Your Money, Your Wealth.
I watch Your Money, Your Wealth. I'm going to be rich.
Hey, we like those emails.
Yeah. I was like, good for you, man. Good for you. So I can't wait for season 4.
Yeah.
No,
well, next January. Here we go.
Yeah, check the TV show out. It's on CBS here in San Diego, Sunday mornings at 6:30 a.m.
Yeah, you can see what we actually look like.
Yeah, there you go.
Pretty stunning.
6:30, Channel 8, 6:30 a.m. KFMB.
Yeah, and
So
I guess if you don't want to get up that early, just set your DVR.
Yep. That's all you got to do.
Yeah, I know you don't know what that is.
I don't have a DVR.
I was talking to one of your lady friends, and she said, "Yep, Joe, he doesn't get a DVR. We were watching TV, and I stopped it. And he goes, 'How'd you do that? Did you own this?'
Right.
No, you just stop TV.
I was like, this is crazy.
How do you do that?"
I was like, well, I missed what they said. Let's rewind. I'm like, we're watching TV. We're not watching a VHS.
You can't rewind.
What do you have, a Betamax? What is this?
That's the funny thing is you can rewind TV.
I guess so.
See, you got to get with it.
I got to get new to the times.
But the only problem is you can't fast forward because that's in the future.
Yes.
That'd be cool.
I suppose you can, if you pause, you can fast forward.
Sure.
Because
and that's the whole point. You record and then you can fast forward over the commercials.
Got it.
It's a good thing.
Got it.
But she was saying that you said you like the commercials.
I do, because I'm a capitalist. I like to see what's out there.
I got it.
Let's see what these products are getting hawked.
Got it.
On the, right?
Yeah, right.
Plus it gives me a break. I might have to, go grab a drink of water.
Yeah.
Maybe go to the restroom.
Sure,
maybe do, whatever.
Yeah.
I don't watch that much TV. When I do, it's at night.
Right.
And so that's when I'm like getting things together.
Got it. Okay. Yeah. Makes sense.
Yeah.
But the rest of us,
we just like to power through and binge.
If we need to get up to get another beverage, we just hit pause.
Hit pause.
Right, we get the commercials, we fast forward.
Oh.
Now you can do on Time Warner Cable, you can do 4 times. You can power through the halftime at the football game.
Really?
No problem. Yeah.
Well, I like to experience it real time.
I know you do.
All right. Well, we got. I got a bunch of stuff. What else you got?
It takes care of that. I got other stuff.
But you wanted to give me a quiz, didn't you?
Oh, you want the quiz?
Sure,
okay.
I'll take the quiz.
All right. Yeah. This actually you'll get all of these, I think.
Let's see if our listeners do.
Yeah, let's see if you do out there. So this is true or false. If you take your Social Security benefit early, you'll lock in a reduced monthly payment for life.
Yes and no.
Okay.
Here's the answers. Because you can still suspend your benefit. Here's something that people don't know.
Yeah, that's a good point, Joe.
So let's say I take it at 62. My full retirement age is 66, right? But I take it at 62. Then I would get a 25% haircut on that benefit. So let's say it's $1,000 a month. I take it at 62. I'm locked in at $750. However, once I get to full retirement age and say, you know what, I got other income sources. Maybe I went back to work. I can still suspend those benefits and get my 8% delayed retirement credit on that $1,000 or on that $750.
Do you have to be full retirement age before you suspend? So you start at 62.
Yes. To get the 8% delayed retirement credit, you have to be full retirement age.
Got it. So then you got to wait till you're 66, and it's going to be phasing into 67.
Sure, but you can suspend at any time.
Yeah.
But the benefit at full retirement age is you get a larger increase, right? But how they calculate it is that you get a certain increase before. Here's the technical version of this.
Okay.
It's a reduction of benefit from 66 to 62. It is an increased benefit from 66 to age 70.
Right.
Does that make sense?
Yes.
So that's how they calculate it. Because I did get an email saying, Joe, why don't they just call full retirement age 70? Because if I take it at 62 or 70, right, I get this larger increase. And I think if everyone just thought their full retirement age is at 70.
Yeah, they'd work longer. They'd wait.
But the increase that you receive from age 62 to age 6, or they don't calculate it as an increase of benefit from 62 to your full retirement age. It's a decrease in benefit of a certain percentage.
Right.
Right, it's 2/3 of 1% per month, something like that, right?
And if you do the math, I mean, you could look at it either way. If you do the math, there's more benefit from waiting for 66 to 70.
It's 8% versus 6.
About 6, yeah, because it's a 25 reduction to 62, 25%, which you divide that by 4 years. Let's call it 6%,
6.2 or something, right?
Yeah, right, something like that. Okay, well that's correct. You got that one right.
All right, good.
Except you said true and false, but
it is.
You're right.
Because it's not permanent.
You're right. At what age do you qualify for the maximum Social Security retirement benefit based upon your salary?
Well, this is all Social Security?
Huh?
Is this quiz all Social Security?
No, just the first two.
So
let me give you your choices.
I got bored as soon as I heard the question.
At what age do you qualify for the maximum Social Security retirement benefit? 68, 70, 72?
70.
Of course. Did you get it out there, though? You wait till 70, you get the highest benefit.
If you wait till 72, you just
lost 2 years of benefit. Let's see. Maxing out your 401k is a good way to boost your retirement nest egg. What's the total amount a worker over 50 can contribute to their 401k?
24,000.
That's
18,000 plus its catch-up of 6.
That's right. Okay, easy enough. Let's see.
But that's a good. Let's kind of dive in deeper there, because I still get this. How much are you putting into your 401k plan? Maxing it out.
Right.
Okay, so 24,000. Well, no, not that much.
Yeah.
Well, how much are you putting in? Well, no, 15%. Okay, well, 15% of $100,000 is 15 grand.
Yeah, it's not 24,000.
It's not 24,000. You can put 24. No, I'm maxed out. No, it's a dollar for dollar contribution into 401k plan. So be careful there. Some of you might have room in your 401k. Also, check the catch up. You might be maxing out the standard 18,000. If you're over 50, you can go to 24. That's another $6,000 catch up provision. But in most plans, you're going to have to check the box, right? To say, here, I want to do the catch up of the $6,000.
As well as the regular.
As well as the regular.
Yeah, Joe, that happened to me. That was about 6 or 7 years ago. I didn't realize that myself, and I hit 18,000, and they stopped taking money out. I thought, what the heck? Mm-hmm. And you're right. I think a lot of plans, you have to check both boxes if you want the full 24,000.
And guess what happens is that, all right, I hit my 18,000, and then I get my check, and then all of a sudden I have more money.
It's like, all right.
All right. Do you think people are going to go back and say, damn it, I'm going to check it? But
a lot
of people are saying, you know what, 18's good enough.
It's good enough,
Good
right?
enough.
You are right. How about this one, Joe? This is borrowing from your 401k for non-emergency expenses is generally not recommended.
It's generally not a good idea.
or ever. What are disadvantages of taking the loan? Here's 4 of them.
What, it's tax at ordinary income if you lose your job.
Well, here,
or if you separate from service.
Let me read these. You get to pick one of these 4.
Oh.
You miss out on any potential growth that you may have earned if the money had remained invested. The loan balance becomes immediately due if you leave your job. If you can't pay it back, it becomes a distribution. You'll likely be hit with taxes and penalties. Your loan interest faces double taxation, or all of the above.
All the above.
All the above. That's right. It's just not a good idea. Just don't do it, right? Easier said than done. If it's an emergency and there's no other choice, well, we don't recommend it, but we know you're going to do it.
Sure. Because
we know about 25% of you do it, according to this last survey.
It's quick. It's easy. You don't have to go through all these, whatever, and I get it. So.
Yeah. All right. When it comes to your retirement plan, which of these scenarios could derail your savings? Paying high fees for the funds you plan, investing most of your contributions in your company stock, allocating the majority of your funds in riskier, potentially high-yielding investments to get to your retirement goal more quickly, all the above.
All the above, I guess. I mean, this whole... Got to take another break. Show's called Your Money, Your Wealth.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson here, certified financial planner, alongside Big Al Clopine. He's a CPA. Thanks for tuning in. Hopefully you've enjoyed the show. You can always catch all of our episodes on our website at purefinancial.com, or you can get the podcast at iTunes. And you don't have to download the podcast every week. As you subscribe to it, it just automatically comes to you if you choose to do so. Or you could download it weekly. Whatever your fancy.
Yeah, that's true. It's I know the podcast app that's available for the iPhone. Yeah, you just subscribe to a program, and then all of a sudden they show up, right? So, wow, you get a little.
It's hot in here,
Got
Al.
a little sweaty.
I'm
not sure I needed to see those armpits, but it's too late. I've already seen them.
You'll never get that back.
There's the last.
Jeez.
The last 15 seconds, I'm going to try to erase from my mind.
Oh, my goodness gracious.
God, you really got involved in this show today.
I did. I gave it my all. I did. I bled, sweat, and tears today, brother.
You did.
Jeez. Good thing we're on radio, not TV.
Yeah, they can't see it. I mean, it's funny when we do TV, it's very different, isn't it? I mean, we have to have everything planned out. Radio, you probably know, we just
show up. We just show up.
Let's do this article. We start reading it. Oh, that's not a good article. Let's do another
one. This article stinks. I don't agree with anything this article says, and I'm touting.
But with TV, you got to have everything pre-planned because they they call it elements in the world of TV. So you have to, that's like I guess everyone else would call that a slide, but it's an element that goes up on the TV while we're talking. So all that's got to be pre-planned. We got to have a flow. And then we got this guy, we have this earpiece that the guy's talking in our head. All right, bring up Roth conversions. It's like in the middle of your talking. So you got that problem going, and then you got to, Joe, we got to get makeup for TV. I mean, it's.
Are you complaining? No.
Nah, I love it.
All right.
I get
2 minutes of nonsense.
I get more compliments after a TV show. I think it's because of the makeup.
Oh my God.
Yeah, and you look younger.
Oh, Alan. All right. Yeah, I got some emails. I'm going to buzz through a couple of these, and then we're going to get the heck out of here for today.
All right.
Again, these emails come from Investopedia. If you haven't been to Investopedia, I don't know, check it out. It's free. Ask a question on Investopedia. You'll probably hear it on the air. And they asked me to answer these questions. And the reason why I do it on the air is because we feel that you probably have the same questions that a lot of these individuals have. And sometimes the questions that people send to Investopedia are pretty ridiculous. Mm-hmm. And sometimes it's kind of fun to make fun of it.
All right. So what you got today?
Okay. How do I avoid filing a trust return every year? Interesting. My mother recently died. She had a revocable trust and assigned me as the trustee. She has multiple CDs issued under the trust. Do I have to dissolve the trust by cashing in the CDs to avoid filing a trust return each year? Or can I use Form R1 to declare the income under my Social Security? After 2016, do I only have to file a tax return under my name?
Okay, good question. So let's start with this. So your mom died with a revocable trust. When she passes, it becomes irrevocable. And so now it's under the terms of the trust agreement.
Not necessarily. I mean, it's, well, okay, go on.
In general.
I'm sorry.
Yeah, I mean, yeah, pretty.
Yeah, all right. I thought
that's a living trust becomes an irrevocable when she passes.
Sure.
So now you got to go under the terms of the trust. And if the trust allows you to distribute the assets to the beneficiaries, which maybe it does, maybe it doesn't, you don't have to cash out the CDs. You can just distribute the CDs in kind. If you're the only beneficiary, they get distributed to you. And
right, you just change title is what you need to
change title, yeah, and then all of a sudden you don't have to do a trust return. Otherwise, though, if you keep the assets in the trust, you do have to do a trust return. I think it's around, I want to say $400 of income before you have to file a trust return, but maybe it's $100. Don't quote me. There is some threshold, nominal amount. If you make less than that, you don't have to do a trust return.
So here's a confusion. All right. So I'm the trustee. Mom dies, and so now what happens? Well, if I'm the sole beneficiary, all right, so you could just dissolve the trust, right? As long as it is not, let's say, here now the assets have to stay in trust.
Yeah, as long as the
and
trust,
you only you're an income beneficiary. Let's say.
Yeah, as long as the trust document allows you to do that.
And most revocable trusts do that. That's why they set it up just to avoid probate.
Yeah,
however,
sure.
If I got an AB, right?
And sometimes your parent doesn't trust you because
exactly.
you're a spendthrift.
Trust,
and they don't want you to get the proceeds. So.
Got it.
All right.
So you just have to understand the trust and figure out, okay, well, if I'm the successor, if you're the successor trustee of any trust, I would do a little study, right? So read the trust document, sit down with the current trustee and say, what are your wishes here? What do we need to do? Make sure that you have a document of all sorts of different. We have this estate planning guide, not to kind of throw a plug in here, but we do have this estate planning guide that is gone over like gangbusters.
Yeah, it's a good one.
And so you could get the guide on our website. Go to purefinancial.com. And you can just download it right there online. Piece of cake. And it just kind of tells you the steps that you need to take if like a survivor's guide. So you're the survivor. What do I do week one? We map this thing out for you. So it's a really good guide. So it's free. Just go to our website, purefinancial.com. All right. Here's another one for you. Let's see here. I am a non-U.S. citizen living outside the U.S. and trading stocks through a U.S. internet broker. Do I have to pay taxes on the money I earn?
That's a great question. Non-U.S. citizen living outside non-U.S. person living outside the country. The answer is no, because it's not considered source income in the U.S. just because you have a company that's on exchange. It's just like if we had a company, like if we invest in a company in the Netherlands, we don't have to report Netherlands tax.
So what he's doing, let's say he lives or she lives in London, and he's using Chuck Schwab as his discount broker.
That's fine.
Right.
Yeah. And however, if you own an interest in a company where you get it like a K1, right, or if you own property in the United States, then yeah, you'd have to file taxes in the U.S. even though you're not a U.S. citizen nor living in the U.S.
This individual is just trading stocks.
Yeah.
All right. Do I have? All right. Let's see. How do Roth IRAs gain interest? From what I understand, Roth IRA. These are email questions I'm reading here, folks. Just FYI.
This isn't your question.
This is not my question to Alan. Here's someone just turning in. Oh, God.
God,
this guy's a certified financial planner.
Worst financial show I've ever listened to.
Oh, my God. What the hell? Good boy. Okay.
Like, yes, Joe. They earned interest. Next question.
Thanks, Alan. I had a question from a client.
Yeah.
From what I understand, Roth IRAs don't really gain interest. They are just a vehicle for you to set aside money. After 20 years, the funds get put into a mutual fund that does gain interest. Is this correct? Do I need to find the mutual fund and put all my saved up money into it, or does the money automatically get transferred from the Roth IRA to a mutual fund?
I suspect she's getting confused with the Myra, is my guess.
The Myra is that stupid account that the federal government set up that you can put in like $6 into. I think it's still $5,500, $65.
Yes, I think it is. And by the
then
time
you put it into treasuries.
Right, and so you do earn interest, but it's very little. It's nominal, and by the time it gets to be what, 15,000 or 12,000 or something,
20.
then it has to be transferred into a regular Roth IRA, and then you have the ability to put it in a mutual fund that invests in stocks.
So Roth IRAs is a different animal. Roth IRA, you can invest in anything that you want besides life insurance and collectibles.
Right.
So if you like stocks, if you like bonds, if you like mutual funds, exchange traded funds, whatever, gold. All right. Quick question for you. Okay?
Yeah.
So let's say I have gold outside of my retirement account that's collectible in a sense. It depends on what type of gold that I own.
Yeah.
Right. So then I have to pay a different tax rate, right? What's that rate?
You do. You have to pay 28% capital gains rate.
How about if I hold it in my Roth?
If you hold it in your Roth, I believe it's still tax-free.
Tax-free. How about if it's in a retirement account? Then I just pay what?
Ordinary income tax.
So when you look at all you gold bugs out there,
Right.
there might be a more efficient way to hold the gold.
Yeah.
You could have a self-directed IRA that could hold the gold, and if you're in the 15% tax bracket or holding it into a Roth, right? So that could help you.
Yeah,
as well.
and I'll tell you something else. If you have your gold outside of a retirement account and you want to sell it, if you have stocks in a loss position, those losses will net against the gains.
Right, so it's a 28% tax on the gold, but if I have a stock loss, capital loss, that would offset dollar for dollar.
Right.
So then that's why tax loss harvesting, if you like gold, is going
Yes.
to be a key component here too.
Right.
Hey, we're out of time. We're at the end of the show. Hopefully you enjoyed it. Go to our website at purefinancial.com to get more information about us, about all the great things that we have to offer our lovely listeners. Have a wonderful weekend, everyone. Thanks for sticking around. For Big Al Clopine, I'm Joe Anderson. The show's called Your Money, Your Wealth. We'll see you next weekend.